Greetings. My name is Richard Gunderson, also known as Mr. Trader 911. This video presentation is titled Revealing Facts About Media's Influence on the Stock Market. In April of 2010, TV Week published an article titled The 10 Most Powerful in TV News. In July of 2010, when this video was originally produced, the economy was considered as the most powerful force in reshaping TV news during that year. Here we are over 1 year later and nothing's changed. The economy continues to be a major focus. In 2009, network newscasts had an average of 22.3 million viewers each night. Morning shows had an average of 12.8 million viewers. I'm sure the numbers have changed in 2010 and 2011, but the point here is that the news media is powerful and heavily watched by the American public. Jim Cramer's Mad Money show generally has several 100,000 viewers each day. When Jim Cramer makes a buy recommendation for a particular stock, many of his viewers will immediately take action. I call this herd mentality. If Jim Cramer says it's a good investment to make, the herd runs out and makes the investment. The next day, the price for that stock quickly moves higher. If you choose to run with the herd and you also submit a buy market order for that stock on that day, you'll likely pay a much higher price for that stock. In order to fill all those buy orders, the market maker has to move the price higher to entice others to sell. Usually after a few days, possibly a week, the price of that stock will fall back down to a lower price because the pressure on the buy side will have diminished. If you wanted to buy that stock and you had patience to wait for 3 to 5 days, you probably could buy that same stock at a much more reasonable price. There is a class of investors called institutional investors. Wikipedia defines institutional investors as organizations that pool large sums of money and selectively invest those sums in stocks. Their role in the economy is to act as highly specialized investors that invest on behalf of others. Institutional investors have professionals on their staffs that are experts at researching companies. They search for the pick of the litter in stocks. They have the time and the know-how to pick the very best investments. Often the people they represent use that information to make investments before the media is fully aware of it. As a result, once the media gets hold of the rising price for a stock and they start to talk about it, it's already old news, and subsequent increases in the price for that stock are overly inflated. When the media reports good news about a company, that company's stock often experiences a rise in its price. Bad news about a specific company generally results in the selling of shares. There are times when news communicated by the media results in a negative emotional response from investors, and a stock may go up or down regardless of the financial performance of the company. At times, a negative news report can cause an overreaction that creates an investment opportunity. For example, I saw a news report one day that indirectly impacted the price of a particular bank stock. That news caused that bank stock's price to drop more than 10%. I knew of no reason for that stock to be selling that cheaply, and I believed that particular stock was inappropriately punished. So I immediately bought some shares at this low price. Within a matter of days, the shares in that bank stock recovered back to the original price, and I made a nice profit on that trade. I believe it's extremely important for investors to get formal training that will equip investors with the knowledge and tools to independently evaluate stocks. Short-term traders tend to focus more on the use of technical analysis. Long-term investors tend to focus on the use of fundamental analysis in their evaluation of stocks. I recommend a combination of both fundamental and technical analysis. Personally, I use both, and they work very well for me. In summary, the media plays a very important role in communicating news. In listening to the news, it's important to recognize that news people are often biased in their reporting. News people are not experts in all things. They often don't have the time to fully research the news they're reporting. News people need to present views that hold viewers' interest and increases their viewership. This may result in some embellishment of the story, creating false impressions of what's really going on in the economy or the stock market. It can also result in an improper response to investor buying or selling of particular stocks. Investors need to listen to the news to get bigger picture of the economy in order to make more informed investment decisions. At the same time, investors need to be careful not to overreact to a specific news story. Temper your emotional reactions to news and look for opportunities to take advantage of overreactions on the part of the market. Have a great day.